You've probably run the numbers on a house you wanted, and at some point, the math just stopped making sense. The price was too high, the rate was too high, or the insurance quote came back and you genuinely thought it was a typo. And the explanation you keep hearing is supply and demand, or the Fed, or just wait it out. Here's the thing. Those explanations aren't wrong, exactly. They're just missing about 3 layers of what's actually happening underneath. And one of those layers involves a lawsuit, a piece of software, and some of the biggest landlords in the country doing something that, if it had been done over the phone instead of through an algorithm, would have been called price fixing from day one. So here's what this video is actually about. The housing affordability crisis has 3 real engines driving it, and most coverage only touches one of them. We're going to go through all 3, starting with the one that has a paper trail and a settlement attached to it, moving into the math problem that's been quietly locking millions of homes off the market, and ending with the one almost nobody's talking about, the one that a Senate committee has compared to 2008, and the one that's now quietly disqualifying buyers who thought they were already approved. By the end, you're going to understand this market in a way that most people, including a lot of people in real estate, genuinely don't. Let's start with rent, because for a lot of people, that's where the story begins. You couldn't afford to buy, so you rented. And then rent went up. And then it went up again. And the explanation was always the market. But here's what the market was actually doing. The DOJ sued a company called RealPage, alleging its revenue management software used non-public, competitively sensitive information shared by landlords to set rental prices. Think about what that means in plain terms. Competing landlords agreed to share private data about their rental rates and lease terms with RealPage, and that software then generated pricing recommendations for all of them, based on what their rivals were charging. In a normal market, those landlords would be competing against each other to attract renters. In a free market, they would otherwise be competing independently based on pricing, discounts, concessions, and other dimensions of apartment leasing. Instead, the algorithm was essentially telling them all to move in the same direction at the same time. The DOJ also sued 6 big landlords, accusing them of using algorithmic software to work together and raise rents. 6 of the largest landlords in the country, managing over 1 million apartments across dozens of states. And the DOJ's own complaint alleged that one landlord raised rents more than 20% within 11 months of adopting the software. This wasn't the market went up. This was a documented, accused pricing scheme with a paper trail long enough that the federal government spent years building a case around it. On November 24, 2025, the DOJ filed a proposed settlement to resolve its antitrust claims against RealPage related to certain of its algorithmic rental pricing software products. RealPage did not admit to liability, but did agree to undertake certain actions and refrain from certain conduct. So no admission, but a settlement, a court-appointed monitor, and a 7-year compliance window. And here's the part that's still playing out right now. New York enacted a law making it explicit that algorithmic rent setting by landlords could violate state antitrust law. California also recently amended its own antitrust law to broadly regulate the use of common pricing algorithms. RealPage filed a complaint challenging New York's law as a violation of the First Amendment, arguing essentially that its software has free speech rights. That case is still going. Most renters have never heard of it, even though it directly shapes what they pay every month. So that's the rental side. But here's where it gets interesting. Because even if you got past rent and tried to buy, the for-sale market had its own invisible wall. And this one wasn't built by software. It was built by math. During the pandemic, mortgage rates dropped to historic lows. Millions of homeowners locked in rates below 4%, some below 3%. Then rates climbed to 7% and 8%. And suddenly selling meant trading a $1,400 monthly payment for a $2,600 one. For the same house, in the same neighborhood. The math didn't work, so people stayed put. Economists call this the lock-in effect. And for the past several years, it's been one of the most powerful forces in residential real estate, and one of the least covered. Here's the number that makes it concrete. Research estimates mortgage rate lock-in is preventing about 870,000 home sales in 2026 alone. Nearly 1 million transactions that would have happened in a normal market, just gone. And the Federal Housing Finance Agency found that for every single percentage point that market rates exceed a homeowner's locked-in rate, their odds of selling drop by 18.1%. That single dynamic, people not selling because the math punishes them for it, increased home prices by 5.7%, more than offsetting the price cooling effect that higher rates were supposed to create. Higher rates were supposed to bring prices down. Instead, they froze the sellers, which kept inventory tight, which kept prices up. The medicine made the patient sicker, and the people sitting on those low rates aren't villains here. Borrowing just an existing mortgage balance on a new mortgage at today's rates could require a monthly payment 41% bigger for the exact same loan amount. Nobody's going to volunteer for that, so they stay. And the people who want to buy have nothing to buy. Now, there is something shifting right now that almost nobody's covering, and this is the open question I want you to hold on to until the end of the video. For the first time, there are now more homeowners with mortgage rates above 6% than those with rates below 3%. That shift marks a quiet but meaningful turning point for housing supply. As of the end of 2025, 21.2% of outstanding mortgages carry rates above 6%, the highest share since 2015, and nearly 3 times higher than the pandemic-era low. What that means is the golden handcuff era may quietly be ending. The question of whether that actually unlocks inventory, and how fast, is the thing that will define the next 2 or 3 years of this market. I'll come back to that. Because first, we need to talk about the third engine, the one that's been hiding in plain sight inside your monthly payment. And this one, I'd argue, is the most underreported story in housing right now. Insurance. Not the mortgage rate, not the sticker price. Insurance. Between 2008 and 2024, homeowners' insurance costs jumped 74%. Home prices over the same period went up about 40%. So insurance outpaced home prices by nearly double, and almost no affordability conversation mentions it. It's always rates and prices. But the insurance line in a monthly payment has been growing faster than almost anything else, and it's now often the fastest growing cost a homeowner faces year over year. And it gets worse than just the price. Federal Reserve Bank of Dallas research found that for every $500 increase in annual homeowners' insurance costs, a borrower becomes 20% more likely to fall behind on their mortgage. Think about that chain reaction. Insurance goes up, the monthly payment goes up, the borrower starts missing payments, and suddenly you have a default that had nothing to do with the interest rate or the original purchase price. This is a domino effect that almost never shows up in the "why can't I afford a house" conversation, which almost always stops at rates and prices and never gets to the third line item. But here's where it crosses, from expensive to genuinely dangerous. At issue was algorithmic rent-setting software that prosecutors said enabled landlords to compete less and boost prices. Actually, let me bring this back to insurance, because the story here is even more alarming than cost. Insurers aren't just raising prices. In some markets, they're leaving entirely. Carriers have started pulling out of high-risk regions rather than raise rates, which means some buyers who are fully pre-approved, who have the income, who have the down payment, discover mid-transaction that no insurer will cover the property at all. The deal dies. And it never shows up in any affordability statistic because the buyer was technically qualified. The invisible disqualifier. A Senate Budget Committee report and multiple economists have described the homeowners' insurance affordability crisis as a looming economic threat, structurally similar to the subprime mortgage crisis. Except this time, the defaulting risk is being driven by climate losses and insurer withdrawal, not bad loans. The comparison to 2008 isn't casual. It's a formal warning from people who study systemic financial risk for a living. And research also shows that low-income and minority homeowners are simultaneously more exposed to climate risk and more likely to be uninsured or underinsured, meaning the same affordability pressure hits some demographics with a compounding second blow that almost never gets named directly in these conversations. So let's come back to that open question from earlier. because this is where everything connects. The lock-in effect, the math that's been keeping sellers frozen in place, is showing early signs of breaking. Something shifted in late 2025, and the data from early 2026 confirms it. The lock-in effect is finally breaking. Homeowners are moving again, not because rates dropped, but because life doesn't wait for interest rates to cooperate. The NAR is projecting a 14% increase in existing home sales for 2026, the first significant uptick since the rate surge began. Inventory levels are finally climbing, with roughly 20% more homes on the market now than at this time in 2025. That sounds like good news, and in some ways it is. More supply should help buyers. But here's the catch. More inventory entering a market where insurance costs are rising faster than wages, where insurers are withdrawing from entire regions, and where the Senate is comparing the insurance crisis to 2008. That's not a clean recovery. That's a market getting more complicated, not simpler. The lock-in effect easing is a real and meaningful shift, but it doesn't fix the insurance problem. It doesn't undo what the algorithmic pricing scheme did to an entire generation of renters who couldn't save for a down payment because their rent kept climbing. And it doesn't change the fact that a buyer who clears every financial hurdle can still get stopped cold by a coverage gap they never saw coming. This is why the standard explanation, rates are high, supply is low, just wait, is so incomplete, because it describes symptoms without touching the actual mechanisms. There's a software company that settled with the DOJ over rent coordination. There are close to 1 million home sales being blocked every year by a math problem that punishes sellers for moving. And there's an insurance crisis that a Senate committee has flagged as a potential systemic risk, and that most buyers have never even thought about when they're running affordability calculations. If you want to actually navigate this market, whether you're renting, trying to buy, or already own and wondering what your exposure looks like, I put together a full breakdown guide in a PDF you can grab in the link below. It walks through how to factor insurance costs into your real monthly payment before you fall in love with a property. Here's where we actually landed today. Rent prices were coordinated, at least in part, by software that the DOJ spent years litigating and ultimately settled. Nearly 1 million home sales a year are being blocked by a rate math problem that punishes sellers for leaving their low-rate mortgages, and that same dynamic pushed prices up more than higher rates brought them down. And the fastest-growing cost in a monthly housing payment right now isn't the principal, isn't the interest, it's insurance, which is pricing people out, triggering defaults, and in some markets, disappearing entirely. You came into this video thinking housing was unaffordable because of rates and prices. Those things are real, but the actual story is 3 layers deeper than that, and 2 of those layers have names, paper trails, and Senate hearings attached to them. The market isn't just expensive. It's broken in specific, documented ways. And the first step to navigating it is knowing exactly which ones you're actually up against. If this was useful, the next video on how to actually run a real affordability calculation, one that includes insurance, taxes, and the stuff calculators leave out, is right there.